The S&P 500 just lost you $1 million and you don't even know it yet. Look, I'm a huge investor in the S&P 500 and I'm not here to bash it. But what I discovered after analyzing thousands of investor returns will shock you. While I expose the 4 biggest lies you've been told about the S&P 500, I'm going to show you exactly how much each one costs you. And the total is way worse than you think. And by the end of this video, you will know exactly which traps to avoid. In the next few minutes, I'm going to show you why 96% of investors fail in the simple fix to put you in the top 4%. But here's the thing. Most people watching this video will ignore this and lose money anyway. Don't be most people. So let's dive into number 1. The S&P 500 is a safe investment. Here's what Wall Street won't tell you. Over 40 years, it's absolutely safe. But and this is crucial, 27% of all years are negative. That is more than 1 in 4. And we haven't even started talking about the volatility in the good years. We're not talking about small dips here. So picture this, you have $100,000 invested today, and tomorrow it could be worth $60,000. And add some zeros to that if you want to get really fun. Because as your portfolio grows, so do the swings. $10,000 loss is way more than $1,000, and $100,000 loss is way more than $10,000. Might sound obvious, but when you start to see the swings in your portfolio, it feels a little different. S&P 500 has swung from negative 40% all the way up to positive 50%. That's a 90% swing. And most people are panic selling when they see red in their portfolio. And the second they see red for more than a couple weeks, they cannot handle the pain for that long. And while the average bear market's only 11 months, human nature will make it feel like it's taking forever. While the last decade plus has been all green for the most part, it feels like it flew by. And understanding this crucial element of human psychology is so important. So that panic sell is mistake number 1. You get in there thinking it's a safe investment, but you don't understand what safe actually means contextually. And I know what you're thinking, but everyone just says buy and hold the S&P 500 forever. Technically, there's nothing wrong with that advice. But again, that's why you're watching this video for context. 73% of the years are positive, but without understanding the volatility that comes with it, plus the 27% of the years that are negative, you're just gambling. You're not really investing because you're missing the most critical element of investing, which is invest in what you know. You need context, and that's exactly what I'm giving you today. So when you see a drop of 20%, 30%, or 40%, and you don't understand why that's happening or that that's pretty normal, you're going to make emotional decisions. You'll sell at the bottom and you'll buy at the top, and you will destroy your wealth. But when you understand volatility is normal and even beneficial, everything's going to change, and you'll begin to actually build real wealth. Don't click away because this next part's about to save you money. Lie number 2, the S&P 500 has average returns compared to stock picking. This is going to blow your mind. From 1926 to 2021, 96% of all stocks, 96% underperformed a simple 1-month treasury bill. Wait, what? Yes, the boring government bond your grandpa decided to buy beat almost every stock picker in history. Think about that. 96% of individual stocks did worse than the safest, most boring investment on the planet. Think you can beat the market? Think you're the 4%? Wall Street has billion-dollar algorithms, teams of PhDs, and supercomputers, and they still can't consistently beat the S&P 500. What makes you think you can do this from your phone sitting on the toilet? Look, I'm a former CPA from Deloitte. I audited the biggest companies in the world. I can read a 10K inside and out. I understand financial statements better than 99% of people, but I still don't try to beat the market. And you know why? Because I'm not arrogant enough to think I'm smarter than a billion-dollar algorithm. The market has unknown variables as well that are impossible to predict. A random tweet can rock a stock. A war halfway around the world can crash your portfolio. You can't predict these things. So trying to beat the market by picking individual stocks, mistake number 2. Now here's where it gets really interesting. Lie number 3, the S&P 500 only goes up. People see the stock market charts going up and to the right and they think that it only does that all the time. That is so far from the truth. It's a total roller coaster. But that's actually a good thing if you know how to use it. The market does not care about your timeline. From 1938 to 1954, a 16-year period, the Dow Jones had a 0% return. Imagine watching your money do nothing for 16 years. You put $10,000 in 1938, and in 1954, you still have $10,000. But here's the twist nobody mentions. Those investors who saw a 0 return for 16 years, the ones who actually dollar cost averaged throughout the entire time period, meaning they invested the same amount every single month the entire 16 years, and regardless of the market, they actually made 11% average annual return. That is historically speaking in line with everything we know. How is that possible? Simple math that nobody teaches you. Let's say, for example, you're investing $500 over this time period. When the market goes up, let's say you buy one share at the current price point. But when the market crashes with volatility, you're still putting $500 a month into that same exact investment. And as a result, because the price goes down, you're naturally buying more and it's automatic. That is the power of dollar cost averaging. You have to invest when the market's good, you have to invest when the market's bad, and you have to invest when the market's volatile. And unless you can stay consistent, this does not work. It only works for people that stay consistent. And no, your plans don't change as the market changes. That's the whole purpose of dollar cost averaging. You're not timing the market. This is all automated. This is part of the automatic system that we build. So while everyone else panicked during those 16 years, smart investors were secretly getting rich. And let me be very clear, sometimes it doesn't feel like it in the moment, and oftentimes it does not. So if you start to doubt yourself every time the market gets volatile or go down, you should work with a financial advisor because you will hurt yourself. And this is context to help you with finances and investing. This is not to make you feel good. It's to tell you the truth. So here's the exact math. The market was flat for 16 years. Everyone else, 0% return. The individual that dollar cost average, 11% annual return. That is per year on average. That is better than the historical average of the stock market. So when people talk about the lost decade, just remember the data doesn't lie. People do. That volatility is exactly what scares people out of the stock market. And it's exactly why most people are the average investor, not the average market, which is a big difference, and we'll talk about it in a second. Not understanding how to use volatility to your advantage, that is mistake number 3. And this debatably will cost you hundreds of thousands, if not millions of dollars. But people consistently miss this point, and the pattern recognition that I have every time the market gets a little choppy is sickening because it makes my stomach hurt every time I get a comment or a question asking, should I still be doing the same thing as we once talked about? That is the whole point. Let me show you an actual example I pulled up. So I'm going to walk you through 2 specific situations here. So we have 2 investors. We have one investor that's been investing $1,000 every single month from 2015 up until September 30th of 2025. And we have another investor doing the exact same thing, but during COVID, they panic sold 50% of their portfolio and paused their investing during that volatile time and waited until 6 months after to get back into the market. And at that time, they reinvested the money they pulled from the market during the COVID crash. And then they started back up their $1,000 a month investing. So here are the 2 outcomes of that situation. Scenario A, the individual that stayed the course, dollar cost average, does everything that we talked about. Their total contributions over that time period were $129,000. The ending value was near $296,000. The money weighted average return annualized was about 14.86%. Whereas scenario B, they panic sold in March 2020. They paused and they re-entered in September 2020. Their total contributions were 6 months less, so $123,000. Their ending value was only $256,000. So the money weighted average return was 13.13%. So the behavior of investor number 2 or scenario B cost them $40,000 during that 10-year period. And again, this example doesn't even account for tax impact of selling your shares. It also only shows a 10-year period. So if I extend that to 30 years or 40 years, the compound interest of that decision is going to be hundreds of thousands of dollars. And that is a very small example of what I see on a daily basis. Now, this last lie, this is the one that gets people angry with me. But I like to speak the truth, and I'm okay with people being mad at the truth. And you need to hear this. Obviously, at this point, the first 3 mistakes can cost you 6 to 7 figures, but this one is even worse. Lie number 4. It takes way too long to get rich with the S&P 500. People say index fund and ETF investing are boring or slow, or for people that don't really know how to invest or beginners. Really? Let me show you the math behind this. $1,000 per month for 22 years equals millionaire status, assuming you're starting at 0. Start at 22, become a millionaire at 44. Start at 30, millionaire by 52. That's not slow, that's systematic. The average millionaire doesn't become a millionaire before age 57. And that's an average millionaire, which is a top 7% statistic. That is predictable, and that is achievable for anybody with a decent job, some discipline, in an automated system. But here's what's criminal. From 2001 to 2021, 20 years, the average investor return was 3.6%. The S&P 500 return during that same period, the average boring way, was 9.5%. That is nearly a 6% difference. So let's assume 2 scenarios. Everything is the same except the actual return of the investor. One is the average market, 9.5%, and one is the average investor, 3.6%. And the reason that 3.6% happens is because they're doing everything I'm telling you not to. Sometimes life's about not doing things versus trying to do extra. So assuming that's the case, let's say we have $100,000 invested as of today. We're investing $2,500 on a monthly basis, and we're doing this over a 30-year period. The average market in that situation is going to return about $6.8 million. However, if you're the average investor because you're doing everything I'm telling you not to, that return is $1.9 million. That is near a $5 million difference. If that didn't just make the point to you, I don't think anything will. And honestly, I think it's time for a financial advisor. And you know, I don't recommend that, but it's a better alternative for somebody that's going to make an emotional decision every time the market gets rocky, or tries to stock pick because they're trying to gamify the market, or doesn't stick to a dollar cost averaging schedule because every time the market changes, they think their investment strategy needs to change, or they just can't keep their butt in a seat for long enough to get rich and to guarantee real wealth. I'm going to share a study with you that's extremely eye-opening. The American Psychological Association confirmed people who pick strategies that feel comfortable, quote unquote, stick with them 18% longer. They reach their goals more often than people who pick perfect but stressful plans. And also, Charles Schwab surveyed 1,200 affluent households and found that 49%, 1 in 2 people, admitted to chasing advanced strategies before they had maximized their basic tax advantage savings. This cost them on average $19,000 annually, and investing in tax efficiency go hand in hand together. This is another reason why you keep it super simple. So why did the average investor do so poorly? It is everything I just shared. They tried to time the market. They sold when things got scary. They bought when everyone else was euphoric. They did exactly the opposite of what works. The game is not hard, but everyone else is making it challenging. They think they can beat the market. It's either complete beginners who don't know any better, or extremely smart people who think they're above average intelligence and that they can be the exception. Both are ignorant, and both groups lose. You know what's fascinating? The dumber you think you are, the better investor you'll likely be. And that's based on data, because you'll just buy the ETF or index fund and leave it alone. And Fidelity conducted a study from 2003 to 2013. Their best investors were dead people and inactive people. Why? Because they didn't do anything. The smartest investing strategy is to admit you're not that smart. And this is exactly why I say over and over and over, anybody can build wealth, and you don't need a high IQ to do so. And if you did, I'd be screwed. Now, this is painful, but you need to see it. Let me show you the math that destroys wealth. When you lose money in the stock market, the amount you need to gain back is not equal. And this is the math nobody understands. If you lose 20%, you need 25% to get back even. If you lose 30%, you need 43% to get back even. You lose 50%, you need 100% to get back even. You need to double your money to get back to where you started. Lose 80%, you need 400% to get back to even. 400%. If you're down 80%, you need your investment to go up 5x just to break even. You still think you can time the market? You still think you're going to catch a falling knife? This is why you don't play games with the stock market. The damage from one decision can take you years to recover. While somebody who spent no time, made no decisions, and just built an automated financial system that takes no more than 30 minutes a month, they're beating you without even trying. The cost of believing these 4 lies, over $1 million, like I said in the beginning. That is early retirement. That's financial freedom. And that's generational wealth. So what do you actually do with this information? Here's exactly what to do right now, today, not tomorrow, not next week, but today. First, stop trying to time the market. Set up your automatic investments today and turn on dividend reinvestment. I don't care if it's $50 a month or $5,000 a month. Second, use dollar cost averaging. Same amount, same day, every single month, no exceptions. Market up, you invest. Market down, you invest. Nuclear war, you invest. Make it automatic so you don't chicken out. Third, expect volatility. Embrace it. When you see red, smile. You're buying on a sale. When you see green, smile. Your existing investments are growing. Either way, you win. The only way to lose is stop investing or trying to time it. Fourth, think in decades, not days. The market will crash multiple times. There will be recessions. People will comment on my net worth. And when I update you with my net worth online and the market has one bad day, you'll see comments like, how'd your portfolio do today? Those people are ignorant. During your investing lifetime, you'll see likely 3 to 4 market crashes. That's not a bug. That's a feature. And that's built into all of the assumptions that we have about the investing markets. Those crashes are exactly where millionaires are made. I shared this tweet on April 6th of 2025 during the quote unquote tariff crash. I was right in 2018. I was right in 2020. I was right in 2022. And I will be right in 2025. This was during the lowest point in 2025, which we were down 19% year to date. And as I'm recording this, we're up 13% year to date. And if you can do the math, that means there's a 32% swing since I mentioned this. And again, the individuals that were buying at the bottom are the ones that are benefiting. The ones that panic sold or stopped investing are not benefiting from what I'm talking about. Follow the fundamentals. You will get rich with me. I've done this over and over and over, and I'll continue to do this no matter how long the bad cycles are, because this is how you build real wealth. Look, when people ask me, what investments should I pick? It's impossible for me to answer that question. Simple questions don't have simple answers. Your age, income, risk tolerance, time horizon, other assets, family situation, it all matters. And if somebody answers that question directly for you, if they tell you exactly what stock to buy, what allocation to use, without knowing anything about you, run. They're either trying to sell you something or they don't know what they're talking about. This is exactly why I created my YouTube channel. So you can get the education for free, understand the principles, and make your own informed decisions. This is also why I run my Budget Dog Academy for people who want to go deeper, who want 6 months of handholding to build their own personal financial roadmap. Because here's the truth. Most people think investing is their problem, but they haven't even tracked their expenses. They don't have an emergency fund. They don't understand tax diversification. They're trying to run before they can walk. You need a complete financial plan, not just investing. You need to understand cash flow management, tax planning, insurance, and estate planning. If you don't have all of these elements plus many more, you're leaving so much money on the table, massive amounts of money. Listen, this game is not hard, but you need the right education. You can absolutely do this yourself. Every single one of you watching can build wealth, but you need to stop looking for the get rich quick and build a real foundation. So if you enjoyed this video and all the truth bombs about building wealth, hit the subscribe button right now. I'm not trying to sound like every other YouTuber, but it genuinely helps you see my videos. I post every single Monday and Friday. Free education that literally could make you millions over a lifetime, and I've seen it firsthand. Drop a comment with your biggest takeaway, or tell me what shocked you the most. Was it the 96% failure rate? The 400% recovery from the 80% loss? I read every single comment and I'll respond to every last one. Send me a DM on Instagram or Twitter. Wherever you follow me, I actually respond. I'm here to help you win this financial game, because when you win, you build real wealth and you build financial freedom. That's what this is all about. But here's my final warning. If you just watch this entire video, you don't take action, you wasted your time. Knowledge without action is worthless. The market doesn't care what you know, it only cares what you do. So make a decision right now. Are you going to be in the 96% that fail or the 4% that succeed? The choice is yours. I've given you the roadmap. It's your time to drive. You want to see exactly how I structure my portfolio? Want the specific allocation that built me wealth? That video is right here. Click now while you're motivated. Your future self will thank you, and I'll see you in the next one.